There is no such thing as a guarantee in the stock market. Any company you can lose money on. But companies that were profitable over a 10-year time span or longer have a 6% chance of losing investors' money. Companies that were profitable 9 out of the 10 years, the chance of you losing money on them increases by 21 to 21%. Why? Because there's an inconsistency with profitability. Usually there's a saying, selling may go away. Well, May has been running away. We had a 5% pullback in April, and from April lows, technology has been up 16%, utilities is up 9%, communication services up 6.4%, real estate is up 4%. Why am I saying this? I'm saying this because in April, when everybody was saying the sky is falling, when everybody was in my comments on Instagram saying, what you gonna do now? The market is falling. What you gonna do now? And I was showing the losses. But they forgot the fact on Trappin. See, that's the thing I love. They forgot the fact on Trappin Tuesdays. I came and told my Patreon people, I said, hey, y'all, I'm about to sell this NVIDIA play. Get these hot 600,000 out of here. I'm about to sell this Eli Lilly play. Get that hot 50,000. I sold one of the Google plays. Let me get that. I sold one more play, my AVGO play. I said, let me get that. I got $900,000. And I sold my NVIDIA play. I said, I got her. NVIDIA was $797. And I told my people, I said, if it go lower, I'm getting it. 31 contracts. And then I gave him another play. I said, I got in GE. We wound up getting in GE. We got in GEV. We got NVIDIA. We did a QQQ call. I did 2 AVGO calls. We did an AMAC call. I did 2 meta plays. Everything up except for the AVGO call, and I did the ServiceNow call recently. What you gonna do now, Trap? The market is falling. Listen, it's a part of the market had ran from October to April. Damn. You don't never think the thing gonna stop? So we got that 5% pullback. Voila, there go them bricks. There go them bricks. There go the bricks. And guess what? We're going to get another one. So we should get a summer run. We should get a summer run. We should get a run. I think we'll get a run up until about July. I may be wrong, but we usually get, after this earnings call, we usually get it ain't gonna be nothing crazy, but we usually get a good little summer run. And then around August, start pulling back, putting us in position for September. And so what we should be doing is saying, all right, let me eat here. We got another earnings call going to come around July, August. We'll get another earnings season going to come late July, August. From there, I'm not going to lie, Patreon, I'm going to start chilling. I may get a couple, but around August, I'm sitting down. We're gonna see if the market gonna pull, but now it's the election year, so I gotta go do some research and see what September look like in the election year. Because then we're going to September, then we're going to October, then we're going to election. So but I'm always bullish, but the reason why I was super bullish this year is because I went with the data. The data says that election years, we get up seasons. Now, Can I say that I knew NVIDIA was going to do this and NVIDIA was going to do that? I didn't. I can't claim I'm going to do none of that. But here's what I do know. I do know that when you always in position, you ain't got to chase nothing. And the one thing the Patreon community can say is we always in position. We ain't never had to chase nothing. We took our L's on the chin. We kept going. We ain't never had to chase nothing. Everybody, and in my Trappers Anonymous community, we ain't never had to chase nothing. We always, when a run came, we ain't had to say, damn, what I'm going to do now? We always was a part of the run. When it was a quality company, we was always in position to take advantage of it. In Trappers Anonymous or in the Patreon, we never had to chase no rally. We was already in position. Whether it was the Facebook rally, whether it was the NVIDIA rally, whether it was Eli Lilly rally we never had to chase nothing. The only one I didn't partake in was SMCI, and it's because the options on that just look trash. But we got it with NVIDIA and Broadcom. Go a little further, Tudor. All right, so just looking at the 5 worst years in the market. You had the Great Depression in 1929, minus 43%. Now, that did take between 1929 and 1937, the Great Recession and then the recession. Those were horrible. It took 25 plus years to get back in the game after that. So I want to tell you, when you always hear people say, man, the market always shake back. It does, but that one took 25 years to shake back from. That one took 25 years to shake back from. And then we had the bear market of 1973, which was caused by the oil crisis. It was caused by the oil crisis. OPEC said, we ain't giving y'all nothing. And then we had the dot-com bubble. And then, of course, we had the financial crisis. Now, what I always like to look at and what I want y'all to look at is I want you all to go look up these situations. I want you to go look them up and I want you to go study them, all of them. I want you to go study all of them and I want you to see how people navigated through those situations. I want you to see how people navigated through them. I wrote something down that said the possibility of losing money with any stock greatly diminishes for a company that is consistently profitable. I wrote that down. Watch this. Companies, this is just me doing research, so I'm a researcher. So listen to me well, these 3 things. And it's the reason why I want you to study this because there's a certain kind of stock that comes out on the other side of this thriving. Right? There's a certain type of stock that comes out on the other side of this thriving. So I wrote these 3 things down for y'all that I want y'all to get. The possibility of losing money with a stock greatly diminishes for a company that is consistently profitable. That's 1. 2, companies that were profitable over 10 years have a 6% chance of losing investor money. So we're talking about profitability. This is something I'm going to go over in you coming to the Portfolio Masterclass? All right. This is something I'm going to go over in a Portfolio Mastery. Companies that were profitable over 10 years, meaning they had over a 10-year profitable, right? They were profitable for 10 years or more, right? Has a 6% chance of losing investors' money. Watch this stat. Companies that were profitable 9 of 10 years have a 21% chance of losing investors' money. So a company that's inconsistent with profitability, you have a higher chance of losing money on. And that's why we're going to walk you through finding profitable companies when we talk about the portfolio mastery. Because the goal for me is to help you set a time horizon and have an investor criteria when building your portfolio. because you have a better chance of making money that are profitable with companies that are profitable over the long term. Come on, y'all. Come on, y'all. The possibility of losing money with a stock greatly diminishes for a company that is consistently profitable. Number two, companies that were profitable over 10 years have a 6% chance of losing investor money. Now, the reason why that is important is because there is no such thing as a guarantee in the stock market. There is no such thing as a guarantee in the stock market. Any company you can lose money on. But companies that were profitable over a 10-year time span or longer have a 6% chance of losing investors' money. Companies that were profitable 9 out of the 10 years, the chance of you losing money on them increases by 21%. Why? Because there's an inconsistency with profitability.